the bank.
Hey Brett, how's it going this week?
Good, Ange. How are you?
Pretty good. Well, that means it's another episode of Money in the Bank, the podcast where we talk about all things related to personal finance. And you know what really stinks, Brett?
Me on that one podcast episode we did.
Well, that's very true. But also because it's property tax season, which means we have to come up with a whole bunch of money to pay our tax bill.
Yay, all of a sudden, right?
Yeah. I mean, it's just right here, right now, and it's unfortunate, right?
Yeah.
You know?
It's not even, April, so I don't even expect to pay taxes right now.
That's for income taxes.
So that's my taxes. That's what I associate taxes with, right?
So for your trivia question, how much could you expect to save if you decide to pay your insurance premium for your car in full instead of monthly? So you pay it once a year instead of monthly.
Is anybody else following these trivia questions? Like, am I just guessing around? Everybody else is just like, oh yeah, obviously, this is the...
I think this is just common knowledge, yo.
You went kind of down the rabbit hole. If it's this, with
No.
this,
So,
and
like,
this, and this,
when
and
you
this,
buy auto
then what is
insurance,
it?
you can either pay monthly or you can pay annually.
Sure.
How much do you save by electing to pay annually instead of monthly?
10%.
Yeah.
Yeah. Because I've renegotiated our car insurance like 6 times in the last 4 years.
So it can be anywhere between 10 to 15% depending on the company.
Mm-hmm.
And so you might be like, why are you talking about property taxes and why are you talking about auto insurance? Well, it's because those are both really good examples of lumpy expenses, I guess is what we're going to call it.
Lumpy. All right. This is the technical term, folks.
So it's basically when you have expenses over time that they don't come up monthly, right? So all of a sudden it hits, all of a sudden it's annual, property tax time, and you're like, oh crud, where is this money going to come from?
Mm-hmm.
And
yeah, that's pretty lumpy.
Yeah, and well, or with your, auto insurance, it's like you pay 0,0,0,0,0, and then all of a sudden, it's like $1,000 or whatever.
Spike. Which is the right choice because people that are in this model make out ahead of time, right? You either get more money that you have, more money is more power the earlier on that you have it because it either makes you more interest, compound interest, etc., or, you're not paying expenses throughout the year and then you get to save all that extra money.
Right.
So both sides of the coin. You're either getting it or you're not spending it.
Yeah,
Either
and so
way.
with auto insurance, some people make the argument of like, oh, I should pay it monthly because let's say I save up $1,000 to pay my annual premium, but then I could only spend, $100 a month on it. Then I can just bank all that money and get the interest. Well, you're probably not going to find 10 to 15% interest anywhere, which is why it becomes better to spend the money all at once. You don't get the interest on it, somebody else does, and then start re-saving for next year. And that's the key. Start re-saving for next year.
Right, which is what a lot of people forget about. And I mean a lot of people.
Most people.
Yeah.
And so the key here is a lot of people, when they're doing their budget or they're deciding each month, can I afford to go out to dinner with my friends or can I afford to go on a weekend trip? They just look at how much money they have in the bank and they say, yes, I can afford this and I want this, so it's mine. And that's not a good way to do it.
It's point in time financial analysis, right?
Right.
Yeah.
And so what we recommend doing is more, not point in time, what would we call that? Comprehensive financial analysis. Mm-hmm. So you're not just looking at, do I have enough money for tomorrow? You're looking at, do I have enough money for all the future expenses that I know are already on my radar? So that's always what kind of surprises me because people tend to treat insurance or property taxes as a surprise. Mm-hmm. And they're like, oh, my emergency fund can help me cover this. But it's not an emergency because
it's normal.
We know it's happening.
Right. It was should have been on the calendar, right?
Right.
And that's where a lot of people get into trouble with budgeting too, is because they look at a monthly budget statement. And a lot of times we've talked about them before, you just look at your regular monthly expenses and stuff like that. That's the general oversight. But if you look at your annual budget, you've got a couple other dots plugged in there that you may not have when you look at your like January, 1st to January 31st budget.
Exactly.
So
yeah, it's good to kind of look out 6 months to a year ahead and say, what are other things I know I have coming up? Maybe it's a trip, right? And so vacations are another really good example of, it's not like we're like, oh, this month is July and we want to go to Hawaii. It's like, that would never work, right? Because it's going to cost few $1,000s. We can't just do that on a whim. So instead what you do is you say, where do I want to go next year? Maybe next July we want to go to Hawaii. How much do we have to set aside every month until then to afford that trip?
Right. And how much, if I cut things back here and there, is that filling up that bucket faster?
Right.
To get to that trip.
Yeah, so Brett, this could actually be a great episode for you because I call them sinking funds, but you always kind of call them your buckets. And so when I met you, you had 15 different accounts at your bank.
There was there were like 10, something like that. Yeah, so I had allocated, you could open as many checking accounts, I think, as you wanted to, or no, savings accounts. You could open as many savings accounts as you wanted to. And so I got like 10 of them, and I named them all different buckets, right? Or different things that I wanted. One was for a car, one was for vacation, one was for like regular expenses, like Christmas presents for friends. Like I just had like different groups of categories. So that's what I called buckets. And I would like allocate different amounts of money into those different buckets. Right. And so some of them I had to move manually because my company would only like distribute money from my check into like 5 different accounts. So when unfortunately I had to just like move money around manually every month. But putting things toward a car or putting things toward trips, and I would fill up that trip bucket, and then once the trip bucket was filled up, that would spill over into one of the other buckets, right? And so then I would just like keep dumping money from one thing to the next based on priority. Yeah, and so now I would say, instead of having such an elaborate scheme, because I took over from managing our finances for, the most part, and I wasn't going to just keep moving money around like the hokey pokey. So now we kind of have one big bucket. So I would say we have 2 buckets. We have one bucket, which is our true emergency fund. So this would be for something completely unplanned, unexpected, or, maybe we knew it could happen eventually, like maybe we need brand new tires for our car. But maybe we just got brand new tires 6 months ago and we hit a giant pothole because we live in the Midwest where the roads are horrible. And so our new bucket for car maintenance wasn't filled back up in 6 months. So that's where we have an emergency fund. That's like our safety net. And that's going to allow us to kind of be able to recover from any of these really big unplanned expenses where we just didn't quite have enough, right? Or large scale situations that you don't want to go to your insurance for to create a claim that's going to increase your rates. Like, something bad happened in the house, or, I got in a car accident, but it's not a bad enough car accident that, I have to get it. It's not totaled, so I'm not going to go to insurance. It was just like a fender bender, so I'm just going to pay for the repair myself, right? Stuff like that. Unexpected, unplanned, kind of pretty expensive, but, not worth dipping into the other things for. Yeah, so for one example, when we first moved into our first house, about a month into that house, like half of the siding ripped off of one side of the house. Yeah, we had basically had just under whatever is considered a speed for a tornado, and like 25 pieces of siding were just like blown down the street from our house. Yeah, and so to get it fixed and everything, it was like right around $500. And like I mentioned, we had just moved into that house, so we hadn't started really like a house maintenance fund yet, right? And so that was an area where we were glad that we had our emergency fund. We could pay that $500 expense without having to go to our insurance company because our deductible was $250 or $500 anyways. Mm-hmm. So we would have had to pay it anyways, and that softened the blow. So I always think it's going back to my 2 bucket mentality. I always think it's a good idea to have like a true emergency fund, and I typically keep this between 3 to 6 months of expenses. And then the second layer that we have, or I guess the first layer, is kind of like our sinking fund bucket. And this is where everything else goes. So every month I make sure that we save enough to cover all of our lumpy expenses for the year. So for us, that includes, homeowners insurance, life insurance, auto insurance, property taxes,
a car repair fund, so we have a little bit of a buffer when something goes wrong with the car, like if we need new brakes or new shocks or, whatever normal car repair. But you always want to have some money set aside because, we drive a 12-year-old car, so, sometimes it needs a little love. So I put all of that into a sinking fund account. So whenever something kind of happens, my first line of defense is that sinking fund bucket. And then when that starts getting low, if I misestimated how much I should be putting in there each month, I take a step back and I say, okay, we're going to have to figure out how we can come up with an extra, $100 a month to put in there because our lumpy expenses have gotten a little bit higher.
Mm-hmm. Yeah, so it kind of ebbs and flows, right? As those things, spike up, then, they spike back down again, and there's usually not like too many catastrophes at the same time or unexpected things happen at the same time. And so we can rebalance it out over time.
Yep.
So is that the whole secret? That's it?
That's the whole secret. But I think what's really interesting is it also applies to people who make income at different levels.
Sure. Mm-hmm.
So this is where instead of lumpy expenses, you still have those, but you also have lumpy income.
Right. So when I was in, middle school or something, one of our teachers was telling us about the option that he had to either get paid every month or every month during the school year.
Right.
And so he was like, most teachers that he was aware of got it annually throughout the year because, it's just more difficult to like budget things when you don't have a stable income, for 3 or 4 months out of the year. But he was like, I want the money now so I can like do more with it. And like I plan ahead and I cover those expenses. So is that kind of what you're talking about?
Yeah. And that's really good for him that he was able to plan ahead because a lot of people can't. So for a lot of people, it's, this is how much I make each paycheck and I'm going to figure out how to spend it all.
Right. Yeah. I mean, because it looks really attractive when you're just making an extra like $100 a month or whatever it is, and then all of a sudden,
basically an extra 25%, right?
Yeah, that's true.
It's 3 months a year.
Mm-hmm. But then when you get to like June or like July, and you don't have a paycheck anymore that just shows up in your either mailbox or in your bank account, then you're like, I gotta just eat ramen noodles until we start back school again.
Right,
and you don't have a very good summer.
And talk to my landlord and hope that they'll let me keep the house.
Right.
Right. So that can be definitely a tricky situation. So that's where if you're gonna have a lumpy income, again, it is pretty important to write down all of your fixed expenses. So that's things that don't change from month to month, like your car payment or your house payment, as well as all of your like necessary to live expenses. So that's your utilities, your food, and to make sure you have a plan, like it sounds like your teacher did, for figuring out how do I make sure I'm setting aside enough money each paycheck to cover those 3 months of the year.
Mm-hmm. And so that's, teachers are in one situation because that's an annual cycle. Being on like a variable income in general, or like a freelance kind of a schedule, or entrepreneurs, people that have less or sort of more unstable income, that's right. This is just a more important practice that you just learn how to do really quickly. Yeah,
and for freelancers or people on a variable income every single month who are maybe they're 100% commission based, I think it's incredibly important you know what your annual expenses are, or if you don't know, you should know, right? So you can go back, you can log into your bank account, you can see what am I spending every year, what is my mortgage, everything like that. Write it down, know what your target is, and then it is critical that you have a larger emergency fund than most people, because you might have spikes where you make a ton of money and then the next 2 months maybe are really low for you, right?
Mm-hmm.
So because of that variability, you need to make sure that you have a large enough cushion in the bank to soften those downtimes. And the other really important thing is to say, maybe you're in sales and you have a month where you blew it out of the water, right? And your commission is through the roof. And let's just say something crazy, like you brought in, $10,000 last month. And it could be so easy to say, okay, this is it. This is when I'm going to take my kids to Disney World, right? But it's so much more important if you don't have an emergency fund to say, okay, my normal expenses are, let's say, $4,000 a month. And so $6,000 is going to stock my emergency fund, and I'm going to get that to, 6 months minimum. And then if I, kind of have all the money saved up, and then I have a really awesome month, and, that money's not going anywhere, right? I have extra, then you can do something nice with it, right? And treat yourself. But I think too many people decide to treat themselves first, and then, they actually couldn't afford to treat themselves, and they get into debt 2 months later.
Right. They're borrowing from their future selves, and right. We always talked about before on a couple episodes, setting your future self up for success. Right. So what did past Brett or Angela do for me, and now I'm in a position of power because they just made this one decision. Right. This is the exact opposite.
Right.
Like they just are. Yeah. They're robbing the bank in advance, and then now when annual property or semi-annual property taxes come along, and then future Brett or Angela has to pay for that, then oops.
Yeah.
Right. You just don't want to be in that situation.
So kind of speaking of past Angela, she noticed a lot of variability in college because past Angela would make decisions to work really hard every summer and then not have to work at a job as hard during the school year. So when I was in school, I typically did about 20 credits every semester, which was kind of aggressive, but I was in the honors college, and it was a way for me to fit in all of my classes to graduate with honors instead of, not, I guess. I don't know. It was what I wanted to do. And, one of those sacrifices was I just didn't have as much time during the school year to work. So instead, what I would do after my freshman year, I worked 2 jobs that summer. I worked almost 7 days a week, every single week. I think I had, 6 days off that summer. But, one of my jobs, I'm sitting here and poor me, right? But one of my jobs, in full disclosure, was at a golf course where I was grilling out all day. So it really wasn't too bad. But so I would save all this money. And so that way when I got to the school year, I could pay for my books and I could pay, my annual groceries or whatever, and not have the stress of I have to get tons and tons of hours. So I would still work during the school year, but I would typically work maybe 10 to 20 hours a week. Instead of, trying to work full time and go to school. To me, that just wasn't really attainable because on top of all of that, I was studying for actuarial exams, which are really difficult. So I just didn't have that much time during the school year. And so my income would be super high for, from May to August while I was off.
Super high, making basically minimum wage for
super high,
2 months out of the year.
Yeah. I really banked a lot of money though. And that's when I started my first mutual fund. So anybody, even people making minimum wage, can do it if you try, I guess. And so anyways, it would be a lot higher, I guess, over the summer. And then during the school year, it would be very, very low. Pathetically low, because if you think 10 to 15 hours a week, really at, $7 an hour, or 6 maybe was even minimum wage back then. It wasn't me bringing in a lot of income when I still had all of my expenses. So I had to be really good about not sitting there. And I remember one summer I went into the school year and working 2 jobs, I ended up saving just over $7,000, which for me was a ton of money. And it would have been very easy to think, okay, I'm going to take a week off and treat myself and go on vacation because I worked so hard all summer. But I kept my head down and I was like, no, I'm just going to, this is a little bit more than I thought I'd have, but I'm just going to see how it goes. And I've told the story before about how I started a mutual fund and, really set my future self up for success. But especially in college, it was so tempting because so many people knew how hard I was working. And so they'd be like, come to spring break with me. I know you can afford it. And nobody else can afford it, but I know you can. And I'd have to sit there and be like, no, I'm not going to do that because I want to make sure I can buy my books and I want to make sure I can eat every month. That's pretty important.
Right. And because when you're in a situation like that with like-minded people and maybe they don't have future expenses coming up, maybe they do, but they're just seeing all the money in their bank account. They're like, okay, yeah, we can do all this stuff because, we made a bunch of money now. Right. And
right.
Yeah, it's just easy to fall into that trap. So you got peer pressure, you got people that aren't looking at the future, and it's a dangerous recipe. So
definitely.
It's tough to, even if you are a future looking type minded person, it's tough to resist all that temptation.
Yeah, I think it's super challenging. I know for me the biggest challenge was knowing that I had so much money in the bank, but I couldn't touch it because I felt I was like, wow, this is the richest I've ever been in my whole life. And so for me, what I would do is I would take that number. I would say, okay, I have, $7,000. And I would honestly go into Excel and I would say, instead of looking at $7,000 and thinking that's how much money I have, I'm going to subtract off how much my books cost each semester. And I'm going to subtract off how much my groceries cost every month for the 9 months I'm in school. And so then I would get down to, let's say 2,000. And I was like, okay, so I have a little bit extra, but, what if I want to go out to eat during the school year? Or what if I want to grab a coffee during the school year? And I know these things are going to add up. So instead of putting myself in a position where I'm starting the school year basically at zero, I'm just going to keep an emergency fund. And that was super beneficial because bad things can still happen to you when you're in college and when you're poor. So, luckily I kept that buffer because my tire blew on the highway when I was driving to an interview one time, and that just set me back $500. But had I spent that $2,000 because I was like, oh, it's extra, then I would have not been able to afford tires for my car.
Right.
So I think no matter what income level you're at, it is really important, even in college, even with all my expenses, I always tried really, really hard to keep an emergency fund of at least $1,000. And I think that really helped me absorb any kind of lumpy expenses, even in terms of school itself or, just in life. I think no matter where you're at in life, expenses come up, right? And having that $1,000 buffer really does a lot to make sure you're not going to backslide.
Right, and it's just an extra layer of protection. It's money that's not available to be spent, right? You might as well just look at it as like a black box in your bank account that, if the money goes into it, it's $1,000. If money has to come out of it, it has to get replaced immediately, right?
Or as soon as possible.
As soon as possible, yeah. As soon as the next time you get paid, right?
Yeah, so actually something I did to really help with that, and I think kind of similar to what you did, was I actually opened an entirely separate bank and a bank account with that, or a savings account with that bank. And that was really helpful to me because I could ship over that $1,000 and it could sit in this black box. And when I logged into my normal everyday checking account,
right,
I didn't see that money.
Just harder to get to until you absolutely need to have it, and then you can figure out how to get back into it.
Yeah, you can do a bank-to-bank transfer. It's there, but it's a safety net. It's not for your daily spending.
Yeah, that's a good safeguard. Yeah.
Yeah, and I think once you get to a point, you have more layers of that safeguard. So, we've already kind of mentioned mutual funds, but that can be another good safeguard. So while typically I say if you're going to put money in a mutual fund, you don't want to touch it for 3 to 5 years. Let's say you're diligent about putting money in, but then, shit really hits the fan. And you just need to come up with an extra $1,000. It's not impossible to get money out of a mutual fund. So in a true emergency, you can get money out of it. So you can think of that of that's my double safety net, I guess. And I think that's really powerful too.
So there's one other story that I had from when we were talking with our insurance broker one time, and we, because we have some investment properties, and I was looking at getting commercial insurance on a new construction project we were going to be working on. And, he was telling me about the way that model in that industry works is for most all of the trades, so electrical engineering or HVAC guys, a lot of people in all those fields, plumbing too, a lot of those guys only work during warmer weather months in the northern states, right? So it's super slow for them in December, January timeframe. So they will end up canceling their insurance, their licensed insurance for their trade during that time, because they don't really work, they don't really use it. So the way the insurance industry works is if you pay for the insurance for 5 years straight, the price for it almost falls off to almost nothing. And if you don't have it for 5 years straight, and which all of these guys are doing annually, they're just dropping it, so it restarts every year, and they never get to that lower rate. They're just getting hosed. But the people that benefit, the long-term larger companies that have insurance all the time, right? They don't really pay as much. They're paying nothing for their corporate insurance or their corporate contractors insurance, and so right. It's just totally a racket. But that's the way the industry works. So that's how the insurance company is able to price those products, is because the guys that don't plan for the long-term annual expenses year over year end up getting screwed over.
Right.
Because that they're failing to prepare, so they end up paying the penalty for it.
Right, because failure to plan is a plan of failure or something.
Plan to fail. You plan to fail.
Yeah.
Mm-hmm. Fail to plan to fail. Yeah. Let me just say it one more time.
All right. Okay, so I think we covered this episode pretty well. Is there anything else you want to add, Brad, or any last thoughts that you have for listeners?
I mean, I think a good first step is to kind of have these buckets visible to you if you are going to like kind of plot this stuff out and put it into different areas and like get it down on paper. I think it's tough for a lot of first starters that are getting into this to like have it in that bank account because it's so tempting, like you said, to be able to just be like, oh yeah, I have this pile of money here, and I'm not seeing all the things that are tacked onto it. I'm just seeing the dollar amount, right?
Right.
But if you have like a spreadsheet that says like, here are all these things that are tacked onto it, and you're regularly looking at that, or you have all this money just like automatically moving to another location that's a little bit harder to get to, or broken out into, like what I did with like multiple savings accounts that are tagged for all these different things, it's a lot easier to like say, I'm not touching this money because it's for my car, or I'm not touching this money because it's literally labeled emergency fund, and that's not for shopping, right? Or not to going out to eat, or not to go on vacation, because my vacation one is up here and this is a different one, right? And this is, I only have $100 in there, so I can't go on this vacation. I got to go on the next one, right? But then I like prioritize that because like, oh man, I missed out on my vacation, so I better like, I'm going to put more money into that one, and I'm not going to go out to eat as much or something, right? So it just trains you a little bit more to be a little bit more diligent. And then once you have kind of that baseline training under your belt, you don't need the buckets anymore because you're mentally able to just like process that, on the fly.
Right.
Training your frugal muscles, right? We talk about that all the time.
Absolutely. So yeah, I think Brett nailed it. Like a good step one is to set up all the buckets, really get yourself in the understanding that this money is earmarked for something. And I do know that when an expense pops up and you do need to tap into this money legitimately, you will be so glad it's there, and that will like reinforce your decision to keep doing what you're doing. Because that's what really did it for me, was like when I made the decision to not spend all my money in the summer, and then I had, that tire catastrophe, I was like, wow, yeah, like, whew,
good job.
Dodged a bullet.
Good job, past Angela.
And so, but stuff like this comes up all the time, so you'll notice that. And the other really great thing is like, yeah, if you have a car fund and you set aside all this money, when it's time to go buy your new one and you actually have a down payment, or you can pay for the entire car with cash and you don't have to borrow money, that will feel so good. And so it's hard to understand the concept of delayed gratification until like give yourself 6 months to a year, right? And then you'll get into the habit and you'll realize how beneficial it is. So I guess my advice to you, if you haven't started sinking funds yet, take the first step. Even if you just start with one, even if you just open, one, and you say, I'm going to put some extra money in here every month to cover unplanned expenses. Maybe I don't even know what they fully are, but I'm just going to try it and see how it goes, and you'll grow from there. So
cool.
Thanks so much for tuning in this week. If you have sinking funds and you want to share your strategy of how you kind of keep them all separate or how you think about it, I would love to hear from you. I will drop in all of my contact information. So thanks so much for listening. Hey guys, thanks for tuning in to this week's episode of Money in the Bank. Make sure to subscribe to us on the iTunes or Stitcher app so that you get weekly alerts every time we post a podcast. Or if you want, you can visit my website, moneyinthebankpodcast.com. And if you want to reach out with any questions or further comments, please email me at Angie@moneyinthebankpodcast.com. I look forward to hearing from you.
Money in the bank.